The flurry of activity around exchange consolidations, exchanges buying other exchanges, striking deals has seemed to have calmed down over the last couple of months, and that's given us some time to think about the broader impact of some of these exchange consolidation moves on different pieces of the marketplace. Hi, my name is Greg Crawford. I'm the editor of TABB Forum, joined today by Seth Merrin, CEO of Liquidnet. Seth, thanks for joining us.
Nice to be here.
So, from your perspective, Seth, I wanted to ask you, looking at the exchange consolidations, and I wonder if you could tell us your sense of their impact on institutional investors.
I think that's the right question to be asking, certainly of somebody like me.
Right.
But you can see that as high-frequency trading has become such a dominant factor in exchanges around the world, the institutional percentage has been declining. And what exchanges are doing is they're seeing that they have to diversify their revenue streams, specifically away from cash equities.
Right.
So today you can see that the institutions make up less than 10% of the volume on the exchanges. And that's just not a very important customer going forward. So the exchanges, it's too important a constituent to forget about and not focus on. But to date, everybody has really been focusing on trying to provide services in one pool, and quite frankly, one venue does not meet every constituent's needs.
Right. So, given that, are exchanges an appropriate place for long-only investors? I mean, they do, as you say, they're an important component because they have a lot of assets, right? A lot of trading to take place.
Yeah, it's also the investors that the corporates who list on the exchange want to invest in their stocks.
Right.
High-frequency traders don't bring any value to those corporates.
Right.
They are completely valuation agnostic. So it is a very important constituent, but not so much from the revenue standpoint these days. So they're diversifying into derivatives more and into the settlement. And you can see even the Deutsche Bank New York Stock Exchange merger, the cash equities is going to be less than 20% of their overall revenue.
Right.
But there are things that they can do and they should be doing, and that is really focusing on creating a safe and efficient venue for institutions to trade.
Okay.
And what we found is that when you have so many competing interests on a single venue, unfortunately, it comes out of the hide of the institutions, and those are the people that manage money on behalf of us, the mutual funds and the pension funds.
Right, okay. So can you tell us a little bit then about some of the other options that are out there? Obviously, Liquidnet, you guys have built a business around this. What else, what are things that institutions can look to get their business done?
Well, we point to the partnership that we've done with the Swiss Stock Exchange, which is very groundbreaking. Exchanges all over the world have tried to create their own dark pools, and to no avail. They haven't worked. So, and the Swiss Stock Exchange has done the same. So, in partnership with Liquidnet, what we've done is we've combined our liquidity pools so that all of the latent liquidity on the Swiss Stock Exchange is now available to our institutional pool worldwide.
Okay.
And that presents more opportunities for the $13 trillion that our members manage around the world to invest in Swiss stocks. Now, the more investment that they can get and the more efficient the trading is, the cheaper it is, the more trading there will be. So they're going to be able to entice a lot more of the investable assets to the Swiss Stock Exchange, which increases the volume of the exchange, which increases the competition to get at those Swiss stocks, which is good for the stock prices.
Right.
But also from the Swiss perspective, it's very important for these exchanges to go global. And in one partnership, they now open up the global aspect to all of their current local brokers. And now those local brokers can access the efficient markets in 39 different markets around the world.
That's interesting. So it's a different construct, again, to allow institutional investors a broader access to capital around the world, and then from the other side as well, allowing those local to have broader.
It's a true win-win.
Yeah.
Because I think what we are advocating is that you have to have separate pools, tangential. I mean, they should. The exchanges have always been excellent at price discovery, and they need to provide the price discovery, but they've never been good at quantity discovery.
Yeah.
And now that high-frequency trading is becoming a more and more important part of the cash equities business in terms of transactions generated, it's becoming more dangerous for these institutions to be able to trade on those markets. And you can see exchanges all over the world going out and trying to attract more and more of the high frequency.
Yeah.
Now is the time that we have to, and it's incredibly important for the confidence that investors have all over the world in the equity markets to make sure that we do have a safe and efficient market for institutions to be able to trade.
Okay, that's a good point. And talking about high frequency trade, not to to say that all high-frequency trading is speculative, but do you think there's a place for speculators and long-only investors to exist in the same sort of liquidity pool or capital pools, or are we really getting to a point where they need to kind of have separate separate playgrounds?
Unfortunately, it is very endemic in Wall Street that a very few end up making money at the expense of very many.
Right.
And not all high-frequency trading is bad, and a lot of it actually adds liquidity to the
Exactly.
marketplace. But there is a large element of high-frequency trading that simply takes advantage of the supply and demand imbalance that the institutions create every time they create an order.
Yep.
Their orders are so large that that's the out demand over very little supply.
Yeah.
So the high-frequency traders take a look at that, and their computers are watching for that, and they simply trade ahead of the
Yep.
institution, which marks up the stock against the institution. Unfortunately, that means that it's a tax on all of our returns, everybody that invests in those mutual funds and pension funds. So it's gotten to the point, and it's been a very recent development, where it's now absolutely critical for the safety of the market, for the efficiency of the markets, to actually put them in two separate pools.
Okay. And do you think that'll, is there a movement in that direction, Seth? How is that likely to happen if we in fact see that? Is it something that the market will do on its own, or a regulatory imprimatur, this is how we're going to structure? Because when regulators try to get involved in market structure, the unintended consequences.
Exactly, and I'm not advocating regulatory change,
Right.
and I'm not waiting for it as well. But if you're surfing the web and you know that every place that you go is leaving a footprint, and then somebody at the end of that is selling all your information to somebody that you don't want to have it,
Right.
you'll stop going to those sites.
Right.
It's no different from the institutions. They're voting with their feet.
Right.
And if they have an alternative, and ultimately, institutions, now that there is an alternative, they have to understand that out there is sort of becoming the Wild West.
Yeah.
And if you're an institution, you want to execute on an institutional platform.
Right. Great analogy. So I think it's a perfect way to end our discussion on exchange consolidation and its impact on institutions. So I appreciate your joining us.
My pleasure.
Again, my name is Greg Crawford. I'm the editor of TABB Forum, joined by Seth Merrin, CEO of Liquidnet. Thanks for joining us.